Much of 2024 was spent waiting for the commercial real estate market collapse that never happened. Will it materialize in 2025, or is the commercial real estate market capable of avoiding it altogether? In today's video, we're going to look at the latest commercial real estate data and assess what it means for the sector in the months to come. Let's get into it. If the commercial real estate sector had collapsed, I'm pretty sure we would have heard about it by now. No, it hasn't happened. But that doesn't mean the commercial market is out of the woods yet. The reason this is important is because a collapse in the commercial real estate market could lead to a banking crisis due to commercial building owners not being able to pay back their loans and just handing over the keys to the lender and forcing them to take on massive losses and risk insolvency. One of the most distressed parts of the commercial real estate market has been office properties, and that is what we have focused on primarily in these videos. The latest data for the office market has shown a bit of improvement. The national vacancy rate for office properties has ticked down the last two quarters. As of the fourth quarter of 2024, the vacancy rate came in at 18.9%, down from the peak of 19.1% in the second quarter of 2024. Meanwhile, the average asking rent for office properties was $36.31 per square foot in the fourth quarter. It has completely recovered from the initial drop at the onset of the pandemic. One of the reasons looking at office rent is important is because it plays a strong role in valuations for office buildings. As I've mentioned in previous videos, owners have an incentive to keep rents high to preserve the valuation and negotiate favorable loan terms. If we were to see rents trending lower, it could suggest that owners are more concerned with filling empty office space than preserving their building's valuation. If an owner was forced to sell at a low valuation, the new owner would likely lower rents to fill empty space and increase revenue. The fact that rents are still high suggests that many current owners have been able to hold on to the properties for now. So we're seeing some signs of improvement in the office market, or at least signs of stability, but could we expect more of this in the months to come? One of the metrics I like to look at is the Bureau of Labor Statistics estimate of teleworkers, which is their name for people working remotely. As of January, the percent of workers in the U.S. that teleworked, either part-time or full-time, was 23.6%, close to an all-time high. This is a recent indicator the BLS started estimating only a few years ago, and we don't have enough data yet to seasonally adjust it. But when we look at the overall trend, we can see that it is steadily heading higher, which doesn't bode well for the office market. Another metric we can look at for the health of the office market is office using employment. I calculated this by adding up industry employment for the information, financial activities, and professional business services industries. It's not an exact measure of all employees working in offices, but it's a close approximation. We can see that this measure suggests that office using employment has been trending lower since the peak set during the pandemic. After the onset of the pandemic, there was a surge in hiring for office jobs, and part of this downtrend reflects a scaling back of hiring. This can be seen most sharply in information employment, which includes the technology sector. There were big tech sector layoffs in recent years as companies realized they overhired during the pandemic. The soft job market for office using employment is another challenge facing the office market. So even though we're seeing some improvement for office vacancy and rents are still increasing, the increase in the percent of employees who are teleworking as well as the downtrend in office using employment means that the office property market is not out of the woods yet. Let's take a look at a few other charts for the broader commercial real estate market. The overall level of commercial real estate loans hasn't pulled back and is still trending higher. The delinquency rate on commercial real estate loans is also trending higher, which reflects the ongoing challenges for commercial real estate owners, but we're not seeing a sharp increase that would suggest we are faced with an imminent market crash. So overall, the commercial real estate market is not in danger of a crash in the next few months. The latest data for the office property market shows that things seem to be stabilizing a bit, but other indicators are showing that the challenges the office market faces have not gone away. This is something that we need to continue to watch in 2025. The hope is that distressed commercial property owners will be able to successfully negotiate with their lenders to kick the can down the road some more like they did last year until the fundamentals return to a more favorable situation. But what do you think? Will 2025 be the year the commercial real estate market crashes, or is it much ado about nothing? Let me know in the comments section down below. If you want to stay up to date on the developments for the commercial real estate market as new data comes in, make sure you are subscribed to this channel and hit that notification bell down below so you won't miss my next update video when it comes out. And if you like this video, or at least found it mildly entertaining, go ahead and hit that like button to support the channel and help it grow. Thanks for stopping by, and I'll see you in the next video.